Welcome to the Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Today we have an awesome episode. Guest I've been trying to get on forever, Russell Napier, independent financial market strategist, financial historian. He's written some great books, including The Anatomy of the Bear. He founded a charitable venture, The Library of Mistakes. Can't wait to talk about that today. Russell, welcome to the show.
Mab, it's great to be here in this wonderfully exciting new year.
I was having fun this morning because you in Edinburgh today? Where are you?
I'm in Edinburgh today.
My son is 8. We were having coffee this morning and I said, I'm going to chat, with this fella from across the pond. And, I mentioned your library. I was like, what do you think that is? And we had this long conversation. Then I said, I'm going to read you my kickoff question and tell me what you think this is. And I said, Russell said before, when regime change occurs, the greatest risk for any investor is to get all the right answers to all the wrong questions. So I want to hear what you meant by that, because he couldn't figure it out. It was a great intro. What do you mean by that statement?
Well, first of all, I'm a bit disappointed because if you can't explain it to an 8-year-old, then you're probably in the wrong business. Anyway, let's try a bit harder and let's hope that your son gets it. We are dealing with the future. Every morning we wake up, we're asking questions really about the future. And current value, the two together. And therefore, we're asking questions about the future. And the easiest thing in the world is to keep asking the same questions. And that normally works because, let's say you and I are of a certain age. We spent several decades doing this. We've lived in a system and it's taught us the questions to ask and try and answer to profit, to get the right answers. So we keep asking those questions. But history is replete with examples of times when those are the wrong questions because the structure of the system changes. The nature of the whole thing changes. We keep asking the same questions and we keep getting the right answers to those questions, but the markets don't deliver what we thought would happen. And that's telling us that what is actually happening is we're asking the wrong questions. And the reason I use that little phrase over and over and over again is really an advertisement for the study of financial history to say that 90% of your time maybe is best spent trying to get the right questions. And then 10% of your time trying to answer those questions. The beautiful thing, tell your son this, the beautiful thing about finance is you don't need the right answers. You just need better answers than everybody else. And that is, well, not even everybody else, just most other people. So I think we spend too little time trying to work out what the right questions are. And, I've been around for a while. It'd be very tempting for me to say to you, hey, maybe I've been around so long, I know all the right answers. But the right answers I've been using are the right questions. The questions I've been using for the last 40 years are probably completely the wrong questions for the next 5, 10, 15, 20. So that's why I bring it up, because I think we are at one of those inflection points where we have to think about different questions.
So what sort of questions should we be asking? I don't even know. What should we be thinking about here in 2026?
Well, what we all know, whether we're involved in finance or not, is that geopolitically the world is changing. That's on the front page of the newspapers. Bloomberg screen quite a lot. They're all there. You might say, well, those aren't new questions. We've been asking those questions now for 2-3 years. The questions we're not asking is what that means for the global monetary system, what that means for the free movement of capital, what that means for debt burdens, all the things we see every day now in terms of what's happening in Venezuela or in Nigeria or in Syria. These are just 3 countries that have been subject to a form of military attack in the first few days of 2026. So yes, of course we ask questions about that, but what does it mean for the global monetary system, particularly the freedom of movement of capital? What does it mean for inflation? Rather than, will Taiwan be invaded by China? Will Donald Trump make a move beyond Venezuela to Cuba? Those are interesting questions, and the ones that people like to talk about at dinner parties. They make you lots of friends if you're discussing at dinner parties. What we need to talk about is what it means for those issues I've just mentioned. And surprisingly, we're not really doing very much of that.
As you look back through history, I know it's always tempting just to try to look for parallels and, maybe sometimes it rhymes, sometimes it doesn't. I know I've heard you mention in the past that, Europe in kind of the post-World War II period may be somewhat of a parallel today. What similarities do you see? What similarities and what differences are there? Anything we can learn from this?
So as I said, Aaron, it depends where you start. In terms of forecasting the future, we are at a fortunate position, if you like, because we start with one extreme, which will condition quite a lot of what happens next. So one extreme is debt levels, the very high levels of debt, either in the government sector or the private sector, for some countries, both. So that really gives us 5 things that can happen from here on in. And there's the 5 ways that debt burden can come down. So that would be austerity, default, very high growth, hyperinflation, or something called financial repression, which is exactly what you're talking about in that post-World War II period. So how financial markets perform is different in each of those, but it's an interest. Those are the questions you've got to ask. Which of those 5 is it going to be? And when you ask those questions, you're really asking a question of politicians and saying politically, which of these options are the most successful or politically acceptable, probably maybe a better way of putting it. So that's where we have to start. And that's why I look at that post-World War II period, because we clearly had an excessively high level of debt, particularly in the government sector. By the 1980s, it was exceptionally low. And how do we do that? How do we achieve that? How do financial markets behave? The peculiar thing about that period, certainly from 45 to really up until the mid-1970s, most Europeans consider that to be the French call it the Trente Glorieuses. Pardon my pronunciation. The glorious 30 years. Well, it was a dreadful 30 years if you were a saver. Not so much if you were somewhere else. So I'm basing my forecast that the governments will not choose austerity, will not choose default, that very high real growth is possible but unlikely. We might come back to that. Hyperinflation is far too dangerous to destroy these debts, socially, politically, just very dangerous. So we go back into that period and the asset prices will follow a similar trend to that period, depending upon where you start with equity valuations. And there's one thing that everybody needs to know. It's the famous Buffett quote, price is what you pay, value is what you get. So it depends where you start.
It's interesting because in the beginning of that period, now obviously there's some major geopolitical forces that were going on, World War II ending, but you had equities kind of did great at the beginning of the period and then transitioned into the 1970s, which was, unless you had some real assets or maybe some value stocks, it was a tough time with rising inflation. We're going to weave in a few of these. You have a really great presentation called 21 Lessons from Financial History for the Way We Live Now. And a few of these we might weave into the conversation, but you just hit on one you really hit on 2 that I think are probably pretty important. Financial repression, this concept of, inflation running hot or certainly above bond yields. We had this really weird period for a long time where interest rates were 0 to negative. And then you even have this period now for the last couple of years in the United States, which I don't feel like people talk about that much, where many of the risky bonds just aren't giving you much of a pickup in yield over the T-bills. But your number 8 on your list was you said the most dangerous form of speculation is the search for yield. John Bull can stand many things, but he cannot stand 2%. So in this sort of world, what do investors they get pushed into equities? Is it something that we need to consider some precious metals, which seem to be going vertical at this point? Like, how do we think about this post-World War II period and any similarities for the investor?
Well, you very correctly said that the early period of that was pretty good for equities, but that's the bit, depends where you start really matters now, because as we end World War II, and particularly 1949, because that's one of the episodes in my book about the great bottoms, US equities were incredibly cheap. In terms of that Shiller PE, they were below 10. I think the dividend yield was close to 10, which is incredible. But also profits were repressed by an excess corporation tax during the course of World War II. So arguably they'd never been cheaper. Now there's a huge contrast with where the S&P 500 is today. So we may be inflicting the same form of repression, but where you start matters. And now we're starting with excessively high valuations and not excessively low valuations. To flip that on its head, it reflected a weighting where most institutions were heavily weighted into government debt. course they were, because we were funding a war against fascism, and it was a world war, and the savings of the nation. And as the decades moved on, they began to move from debt into very cheap equities. So in that world, you can see how equities do well. The world we start in today is the reverse of that. Particularly for the United States of America, when we break out the flow of funds statistics, what we see is that American savings institutions actually don't own a lot of government debt, despite the excessively high level of government debt. Quite a bit owned by foreigners, quite a bit owned by foreign central banks, quite a bit owned by the Federal Reserve. But actually their weightings in government debt are actually very low. So we're likely to see a shift away from equity towards debt. That S&P 500, by the way, of course, is everybody's highest weighting. I say everybody. I'm not sure the Japanese necessarily have more money in US equities than Japanese equities, but they have an exceptionally high one. The British definitely have more in US equities than they have in British equities. So you can see the risk here. This is not where we were at the end of World War II. In terms of that point about John Bull, for your listeners who don't know who John Bull is, that's kind of Uncle Sam, if you like. It's kind of the equivalent. And yeah, it's saying that John Bull can stand anything except particularly low interest rates, because if you and I are savers, we've had to A, work hard to earn, B, pay a lot of tax, and then C, forego the pleasure of spending to save, and then we think we deserve something in return, and we sure as hell don't think it's 2%. So if your risk-free yield is down to that sort of level, then you go in pursuit of other higher yields. That's the mistake. Now, we're not at that at the minute. We have yields somewhat above that. But the point is, you need to calibrate your risk accordingly. And when yields are low, not to go out chasing higher yields, because you're invariably taking higher risk. I'm not a big fan of yield chasing anyway. Total return is really what you should be doing. Chasing yield is dangerous most times, but exceptionally dangerous below 2%. So in terms of the financial repression, I'm not that fussed about trying to get a yield that compensates me for inflation. I think that would be very difficult to do, potentially dangerous. I'm looking at a total return that compensates me for the inflation, and obviously that is likely to involve quite a significant bit of capital gain. And if it's gold, it's going to be all capital gain. So one of the more dangerous things to do in this environment is to try and get your return via yield. I think it has to be total return. And that's why some equity markets look particularly attractive, because actually, unlike the S&P 500, they seem to be incredibly cheap and have a whole lot of prospect of a capital return to boost the meager dividend yield to get you a total return above the rate of inflation.
You made a reference to another one of your lessons, which spoke to me, Russell. This is because I was tweeting about this yesterday, somewhat the inverse, but we'll talk about both, where you say, always buy equities below 10x CAPE, unless the future holds communism, war, surrender of monetary independence with an overvalued exchange rate. And I was tweeting out an old tweet we had where the US closed the year above 40. And in our historical studies, we had found that, not surprisingly, if you buy an equity market trading above 40 for the next 10 years, your returns are below average. So I think real returns were zero. But the interesting part was, not once could we find in the database that a return was ever above average equity real return of, I think, the 6% in the US that everyone fantasizes about. So the batting average was basically zero. But on the flip side, in the tweet, was actually a tweet from PIMCO. So kudos to them. This is an old one, and we'll put it in the show notes link, listeners. But it was saying if you bought markets when they were below 10, your future 5-year return was like 120%. So the quants got your back on this one, buying cheap and avoiding expensive. What does the world look like? And I want to hear some of your caveats here, because I think, and I could be wrong, as we begin the year this year, the only thing below 10 right now is like Turkey. I think Brazil's close, Hungary's close, but most are in that kind of teens range. Any thoughts?
Well, the first caveat is this is only true for long-term investors. Obviously, momentum has worked exceptionally well. Buying expensive stocks has worked exceptionally well for a year, 2 years, whatever. So when we make that statement, which I completely agree with, by the way, we're talking about a 10-year holding period. I run a course in finance, the practical history of financial markets. We teach in person, we teach online. And we say that, these valuation metrics really don't help you with the next year. So if anyone's interested in the next year, these aren't going to be Very helpful. Yeah, there's not many that are close to 10. China was close to 10 last summer. I'm not a fan of the Chinese stock market. We might come back to that. But remember, even mid-teens is going to get you the 6.5% real. That's the bottom line. If you got a mid-teen, I mean, that's in the very long term. People listening to this might say, well, I want 25 real. Well, fair enough. Go and find 25 real. But if you're getting it 14, 15 times and you hold for 10 years, you might expect reasonably 6 to 6.5% real compounded per annum. And that'll do you quite well. But it ain't going to be 20, 25%. So that fantastic number you gave, over 100% if you buy 10. Yeah, there's not many opportunities around like that. And also you can slightly subdivide a market. I know there's a bit of a risk in going too far with this. But, you can look at mid-caps, et cetera, or value stocks, and they're much cheaper. I want to give a practical example of that because I think it's quite important, which is if we go to 1966, which is when that CAPE is very high, 66 to 68. And of course, the Shiller PE, the CAPE, cyclically adjusted PE, refers to the S&P 500. And if you paid that valuation, you did get very poor real returns, really all the way to 1982. But, and it's a really big but, if you bought mid-cap value stocks in 1966, you actually got a positive real return to 1982. Now, not a significant one, not a huge one. So even within a market like the United States of America, which is I'm going to say a huge capital market, it is a market cap. It doesn't have as many stocks as it used to. But there are other bits of that market which are on more reasonable valuations, and that is more true. Like if you come to the United Kingdom, it's at the cheaper end of the scale. And if you look at the sort of British orientated businesses, they're at huge discounts to the rest of the market. So let's split it up a little bit beyond just the headline index, to the value stocks, the growth stocks by size. And if you start doing that, I think you find stuff. I'm not going to tell you we get down to 10, but I think you'll find some stuff that's getting closer to 10. But it may be smaller cap, not micro cap, but smaller cap. And smaller cap value may be where you find that sort of valuation opportunity.
I think there was a lot more single digit CAPE ratio countries last year. And then you had this somewhat of a face ripper of what we would consider to be ex-US international markets. Some of these countries up 50, 60, 70, 80%. But that's kind of how it works. Things get really cheap. And then all of a sudden you get just a little bit of maybe not even good news, less terrible news, and you can get some pretty explosive returns. People still not talking about it much over here. They're talking about gold and silver a little bit.
I'll give you a little story. I was in New York not long ago talking to let's just say, experts in the world of crypto, and I won't mention their names and AI. And just as a tester, I said, you'd be far better off in shipyards than AI and crypto. And everybody laughed. But of course, it's been true now for about 4 years. The shipyards have been significantly outperforming NVIDIA. But nobody cares because it's not big, it's not bright, it's not shiny. So there is, as you point out, a bull market going on elsewhere. But that one in America has been so big and it's going to change the world. We all know that. But if you want to make money, you have to go for the stories that no one's talking about. And it's not long now before Philadelphia will be launching Korean ships. Can you make money out of it? I don't know, but you should be asking, is there an opportunity to make money out of Philadelphia becoming a center of shipbuilding again? It's an interesting question. As I said, it's about the right questions. If you and I start asking questions about AI, well, everybody's asking those questions about AI. Let's ask some questions that people aren't asking about the other things that are going on in the world. Why are shipbuilding companies doing so well? And what does it mean for other places that we could perhaps invest in?
Listeners will have heard this a number of times. They're probably sick of me saying this, but when I do media, I mention it because it seems so unlikely and inaccurate that people have to go look it up. But I said, look, global value stocks, ex-US, have outperformed the Mag 7. So not just the S, it's like the last 1 year, the last 3 years, the last 5, so like there's been this shift. It's been very quiet. It's underneath the surface. But the biggest pushback I always get, they say, Mehmet, you don't understand. The US has such amazing growth. The fundamentals are better. And you have this interesting number 2 on your list where you say, look, you go back for countries historically, there is no relationship between GDP growth and the return from equities. Price is what you pay and value is what you get. And I feel like that's often a surprise to people. They say, if I could give one crystal ball, just tell me what the GDP growth for this country is going to be, and I'll be able to predict equity markets. And you say, well, that might not be that easy.
Let me give you a practical example of that, because I went to Asia in 1995 as a chief strategist for a stockbroking company. British pension funds at that stage had more money in Asia, ex-Japan, than they had in the American stock market. Okay, so this is 1995. Something very important happens in 1995. Netscape came to the market. Many of your listeners will never heard of Netscape, but it was the launch of a dot-com boom. And it was really that moment in history where the American stock market already had done pretty well, really began to do exceptionally well. But the investors in the British pension fund said, well, wait a minute, the Asian economy is growing so well. Why on earth would we want to go into this American thing? And of course, they missed the biggest bull market in history. It has been the biggest bull market in history. And why did they miss it? Because they were fixated on economic growth. They said, look, the US is going to hit 2.5% real. That's the top end of the range. These guys can grow 5, 6, 7% real. Obviously, if they buy their equities, we're going to do better. Got it completely wrong. And for one reason they got it completely wrong is that the Asian balance sheet was in a mess. And frankly, they didn't even look at the balance sheet. They were so fixated with the growth number. They didn't look at the balance sheet. But I think the best example is China. So I'm old enough to have been there the day that the Chinese stock market reopened for foreign investment. MSCI, of course, being MSCI, created an index to map that performance. That dates, I think, to February 1992. Now, everybody watching this will know that the growth of China since then has outstripped the growth of America. The MSCI China index is lower today than it was in February 1992. So is there a better example of why economic growth doesn't necessarily deliver you good returns as an equity investor? I think in China's case, it goes to the structure of the whole thing. Bottom line, you take a chart, you back the winner in terms of GDP, and my goodness, America outperformance by factors from 1992 against a faster growing economy.
You had a quote that I thought was funny. I want to hear you explain it. You said, look, if you're hiring a money manager today, hire one from South Africa or Brazil. What do you mean by that?
Well, what I mean by that is that they are familiar with financial repression. So my job is to go and visit institutional investors. And when I talk through financial repression and what it looks like, they go, we're never going to get that right. We don't have any of the skill sets for that. You know, even the old guys in here, we started after the Thatcher-Reagan revolution. Government was here and it started shrinking and markets started growing, and we learned about investing in markets, and the government would always get smaller, the markets would always get bigger. And that's our skill set. And we've nobody in here understands what you're talking about. Well, go to South Africa or Brazil because they understand it very well. It's been a financial repression, at the core of which is the state or the government getting involved in allocating savings or manipulating savings, stealing savings, if you like. But very smart South Africans and very smart Brazilians have still made money in this environment legally. Some of them have done it illegally, but there are guys who've done it legally as well. And they've got a skill set to play a different game. So we're playing a different game. I mean, in that period post-World War II, not everybody got poor as the value of savings was eroded. Some people got very wealthy. A lot of people were able to borrow money, buy property or whatever. And fortunes were made in the post-World War II period. But most savers, looking back, using the skill set they'd had since before the war, lost out. So I do think people who've invested in emerging markets are more familiar with this. Even China itself, people who invest in China are very familiar with financial repression, the state action, state moving resources around. So those people are more likely to be able to inform you, as to at least have them on the team to inform you. Because when something happens, when a government announcement comes out and you think it means A, they understand that it means B.
One of the big, it feels like levers and seesaws you talk about that's super important is this constant push-pull between inflation, probably more rare, but deflation type of scenarios. And in one of your lessons, number 11, you talk about, particularly in the US right now, high equity valuations fall slowly when the surprise is inflation, and quickly when it's deflation. Our current repression creates a slow decline. There was a little while I feel like people were worried about deflation during the COVID period, but that seems to have quickly evaporated in the world when it had like kind of zero negative rates. But we're not there anymore. All of a sudden, Japan has got decent interest rates, which is a different scenario than, I don't know, the last 30 plus years. But talk to us a little bit about that, these risks on an inflation deflation seesaw, and what you meant by that.
It's kind of availability bias and the bias of drama. So if I say to you, how do you lose money in the stock market? You'll say quickly. You'll think of 2007, 2009. Many people still think of 1929, 1932. And of course, that's absolutely true. But there are two other periods in here where you lost money kind of agonizingly slowly, which would be 1966 to 1982 and 1900 to 1920. And the difference between them is that if earnings collapse and cash flows collapse, then equities collapse because there is a risk that they simply can't pay their obligations, usually debt, and there may not be any equity. And for those of us who remember March 2009, that's kind of what it felt like. Is there any equity in this thing whatsoever? So you can see how that just flips equity valuations very rapidly. General Electric had been in that index since its creation, the Dow Jones Industrials. And in that first quarter, it was not clear there was any equity in the company. I mean, that's how quickly things change. But if you go back to the 66 to 82 period, earnings are okay. That's the difference. Corporate earnings grow, but particularly in nominal terms, they grow. So why does the equity market come down? Well, it's higher interest rates and lower valuations. And that's a different type of bear market. It was a constant battle against inflation, which at any given point in time, somebody thought they'd won. Investors thought they won. Arthur Burns thought they'd won, and equities would rally because the discount rate or the interest rates were coming down. But it turned out it popped back up again. So you go through a long period like that, and that's the period we had actually before, or really particularly during World War I and after World War I for the American equity market as well. So I'm in a camp that sees it more like that, which is actually not the consensus. I think most people who are bears see it as this great big explosion. You know, crypto crashes, brings down the banking system, private equity brings down the banking system. I'm really quite upbeat about the stability of the American banking system and the British banking system. And I think those banking systems are pretty good nick, which means that if we look at, let's say the bubble that burst that didn't do any damage, which was the dot-com bubble, that did damage to people's wealth, but didn't really do much damage to the economy. The reason being it didn't really damage the banking system. Now, I would go out on a limb and say that when something goes wrong with this, whether it's the end of the AI investment boom, I won't even call it a bubble, whether it's the end of the crypto boom, I don't think it really has significant problems for the banking system, which is a huge contrast to 2007, 2009. So if you say equity valuations are very high and they're coming down, but you don't think there's going to be a great big bust, that's not the same as a recession. It's something bigger than a recession. Then you're looking at another way that valuations come down, and that may be a slower way, a more insipid sort of negative real return, but not potentially crash. I think banks are very important when you talk about bubbles. And having lived through the bubble that burst after 2000, banking system was rock solid. And there were bankruptcies, some big bankruptcies in the sort of fiber area and some other bankruptcies, a big insurance company. But the banking system was okay. I think you look at all the work that's been done on the American banking system since 2009, and it looks pretty solid to me.
There's definitely some differences in where the credit and debt and leverages versus that period. I feel like this next lesson, maybe, I don't know which is your most controversial, but I feel like this one will certainly get a few people riled up, where you talk about technology and you say technology never ultimately defeats inflation. And I feel like you talk to everyone in the AI world and efficiency and profit margins and inflation. And I feel like that's the assumption. I feel like almost everyone I speak to, they're like, yeah, we're going to get through this, any risk to inflation, because tech and efficiency and AI is going to save us. Why might not this be the case?
Well, I did this lecture at the University of Oxford one day, and as you say, it tends to get people riled up. This particular guy was a professor of physics of the University of Oxford, and he held his hand up, and he had on his hand his digital watch, and he explained to me that he'd got this free in a packet of cornflakes or something. But the first one he bought was $850 in 1971. And he said, how can you possibly make a statement like that? So I said, well, let's look up and see what happens to the general price level since 1971. I think the answer was 800%. So it is absolutely true that technology destroyed the price of this digital watch. It is not true, however, that in aggregate, it brought down the level of inflation. Now, what's the difference? Well, now I will sort of show my ideology here. Inflation is everywhere and at all times a monetary phenomenon. I don't agree with that 100%, but I agree with it largely. What has happened in that? If you track the growth in the total money supply against the inflation, it's not too far away in terms of CPI. And we've had unbelievable technological advances since then. Let's start the clock at 1900 and run it to today and look at what's happened in technology. And yet the general price level is, many, many times higher than it was in 1900. So it is possible that AI can bring down the price of some things. But if the governments or the central bankers are determined to create sufficient money, you get a major distribution effect. Some prices come down, but other prices go up. And the ones that tend to sort of go up fairly, in a volatile fashion, but fairly steadily, tend to be the commodity prices when you're in an inflation cycle. It might be some wages. So it's conceivable that this is technology. See, there were technological booms that did bring deflation, but they were under the gold standard when there were restrictions on the ability to create money. So the railways, the canals, all of those things under a gold standard did bring you deflation. But since we've abandoned that monetary anchor, the answer seems to be that technology by itself can't defeat the printing press. So it can have major distributional impacts within the CPA.
As you kind of think about monetary systems, you talk a lot about those as a historian. And I mean, the world we live in is not that old. I mean, as much history as we describe, you look back on the Federal Reserve in the U.S., only been around about 100, a little over 100 years, and talk about being off the monetary gold standard in the 1970s. That's not that long ago. I was born in the 70s. And so you have one where you talk about monetary systems fail about every 30 years. The rules of the old system leave a legacy of bad habits for those in a new system. And I'm curious, one, I want to hear you talk about that, but I wonder, is there any signal we can take from gold and silver going vertical, over the past year or two? I mean, I think gold's outperformed the S&P this century. So anything we can take from that? And what do you mean by this, kind of every 30 years? Are we due for something new, something different?
Yeah. So yes, I think we can take something from the price of gold and now the price of silver about a change in the monetary standard and something much bigger even than the monetary standard. 30 years, people will say, well, that didn't change 30 years ago. Well, it did. At least in my book, it did, which was the movement by China to devalue its exchange rate in 1994, but more importantly, to then manage it relative to the dollar. After the Asian financial crisis, many other Asian countries got involved in managing relative to the dollar, even Japan. Really, all this ran up to 2014. So that was the global monetary system. The interesting thing about it was never agreed. There was never a meeting at Bretton Woods or anywhere else, but it very clearly was a global monetary system. I used to have the good fortune to see Paul Volcker once a year, and he always called it the non-system because it was never negotiated, but it was a system. That system, for those of your listeners who are interested, I've written this, not behind a paywall. There's a big article in it's in American Affairs. I think I wrote on this system that was sort of anchored around the link between the dollar and the renminbi. That is the system we've lived in. It's created huge imbalances in terms of external accounts, asset prices, leverage, whatever. That's the system. So for me, we're calling the end to that system. It doesn't work for America. That's why we have Donald Trump. It actually doesn't work for China because it's got an escalating debt to GDP level. The two of them are heading to at least a Cold War, and we hope only a Cold War. So, this is where we really began this conversation. This is the stuff on the front newspapers, but no one's relating it to this monetary system, this global monetary system, the changes it brings in that, and what this all means. So if you want me to do it very briefly, it's two systems. China's got in one system and with a few allies in there. America will be in another system, and most of the rest of the world will have to be in that system, will have to be based around inflating away the excessive debts. That's the legacy of the old system. And within that, it's highly unlikely that we can expect the free movement of capital to be taken for granted. So maybe I'd usually spend 90 minutes doing that, but you got it there in kind of 90 seconds. So that's the old system. It's ending very clearly, but we're not asking the right questions about what happens when that system ends. Where do you put money to preserve wealth? And that's the sort of focus of my work beyond the lessons from financial history. But there is lots of stuff in financial history that can help you work out where you might want to be putting money in that sort of world. And that's, so back to gold. This is what gold's telling us. There's a new system. There's a new structure. It will have a restriction on the free movement of capital, good for gold. And it will have more inflation, good for gold. And it will have more of the state telling you where you should have your savings, good for gold. That's what the gold price is telling us, these structural shifts that it's picking up, sniffing out. And the really interesting thing about that, I think, is if we go back to the 70s, the wealth of the world was America's. I'm talking about the private sector. It wasn't in India. It wasn't in China. It wasn't in the United Kingdom. India and China had chosen communism and socialism and didn't have a lot of money. Europe was bankrupt after the war. Now you've got wealth distributed across the world in China, India, America, Europe. And if it decides it wants gold because it fears the stuff, the gold is, that's why it's going up. One more thing on gold. The course I run, we recently taught it. We've got, we have gold prices, we have real gold prices back to the Middle Ages, by the way. So we can run a 300-year, 100-year, to 600-year moving average. Pretty good. The returns from gold in real terms are zero. But over the last 30 years, it's been plus 6%. So it's been on a tear. And just intuitively, you and I both know that if you see something that's doing that well, you get very concerned about it. But for the reasons I've mentioned, I still think it's the place to be. And I do still think the 100-year real return's probably going to be zero. So the 6%, we've been getting very well rewarded for gold. But because of the nature of this monetary change, then I think there is more to come.
Someone who travels the world quite a bit and, chats with investors from all over the place, I tend to have a bit of a US-centric worldview here for most Americans. What are some interesting conversations or interesting sort of feedback? Maybe it could either be what the consensus is as you're traveling around the world, or maybe even some interesting non-consensus views that you're hearing, or some insights that you may glean from this worldview.
Well, there is this question of American exceptionalism, which has clearly been true in terms of the quality of corporations that America. I don't want to say America's created, because it sounds like it was the government. It wasn't the government, it was the private sector. And they've come to dominate the digital world. And because that is so obvious, then there's a sort of belief that that's America, and therefore you should invest in America. What I think is not appreciated, particularly by Americans, but maybe more by foreigners, is to the extent by which that's been financed by foreign savings. For a country that runs a current account deficit and also exports capital itself, a huge amount of capital has poured into America for that reason, because America did create these exceptional companies. Now, you might say, well, that's guaranteed to go on forever. And I think when I go to America, I get the feeling that Americans think that's our God-given right, that capital will continue to arrive. But the world is changing. And there are two things that are changing it. One, not everybody, and this might come as a shock to Americans, is convinced that their private sector property rights in America will be honored. So I'll just leave that, think about it. But more importantly, all these other countries, they need those savings back. They need to invest in their own defense. They have chosen to invest for a net zero or less energy intensive or carbon intensive world. They need to invest. They've underinvested. So you are likely, whether it's from Japan or Germany or the United Kingdom, I think the next couple of decades is people liquidating the US securities to fund domestic investment, maybe through their own choice, private sector choice, or maybe because they're forced by the governments.
As you walk around to the coffee shops and pubs over in Scotland and UK and Europe, and, I feel like everyone, you're number 21 and maybe one of my favorites. Extrapolation is the opiate of the people. But I feel like that's true for investors too. Everyone just extrapolates their own lived experience, their own recent past. US has kind of stomped everything for 15 years, but feels like it's shifting. Is the mood improving a little bit for the equity investors across the pond in your neighborhood? Are people getting a little more bullish on some of the local country equity markets? I mean, the pretty monster year in 2025. Is it shifting yet, or too early?
No, it isn't. I mean, I can walk down the street in Edinburgh and I can ask people what happened to the British stock market last year. First of all, most people wouldn't know. And they certainly wouldn't know that it outperformed the S&P 500, certainly in dollar terms. They just wouldn't know that because the press is just full of negative stories, full of doom and gloom. And some of those are legitimate, some of them aren't legitimate. So the idea that if there's a re-weighting underway, that it's kind of over, it was all done and dusted in 1 year, seems to me highly unlikely because the news story, the news flow behind that hasn't been particularly positive. It's one of the interesting things, actually, is that against the background of pretty dire economic news, that those markets have moved so quickly. And it may be just a reflection of what we discussed a few minutes ago. US stock market's 70% of global market capitalization. You don't need much of a reweighting from that to these European countries to see these stock markets moving pretty significantly. Now, I've got issues with mainland Europe and with the single currency and stuff like that. But no, the market, this doesn't reflect this 20, let's take an average and say 25%. 25% up. That'll be local currency terms. It'll be up 30% in dollar terms for the European markets. This does not reflect wild bullishness amongst the public, amongst the investing public, nor amongst institutional investors. And it's really interesting that you've got such a big move without, in a background where you're still looking at, pessimism. In that first book, I read all these copies of the Wall Street Journal 2 months before a bear market bottom, 2 months afterwards. That's 4 times 4, 16 months of bearish Wall Street journals. And the bull sign, was good news that nobody listened to. I think we're still in that phase for these markets, actually, particularly the United Kingdom, where there is a little bit more good news coming along, but everybody's determined to ignore it. So I think it's the beginning of this. And value, mentioned the value stock. I mean, it's not as if the institutional investors of the world have reweighted a huge amount of money into value stocks. As you said, they're doing well, but we haven't really seen, I think, much reweighting. I've got lots of friends who are value investors. Their phones are not ringing off the hook with people wanting to give them money. The bright, shiny thing, which is AI, is still what's attracting the money.
Bookending this conversation, as I was chatting with my son this morning, the other thing I was telling him about, which is one of my favorite ideas that I want to hear you tell us a little bit about, the audience, and that's the library mistakes. Tell us what the inspiration was and what it is today.
It's a long time ago. I got into this business by accident. I was a lawyer by training. And then when I got into it, I discovered that there were people who thought this was really a mathematical pursuit and a mathematical discipline in which decimal points could give you all the answers. Now, that didn't coincide with my own life and what I'd witnessed in terms of business. And my father was a butcher, ran a butcher shop, and I wouldn't have liked to try to define his business plan or future by a spreadsheet and a decimal point. So from the outset, I thought there has to be a better way of thinking about this, which is why I started reading financial history. Now, a long time has passed since I entered this industry, but that spreadsheet is still kind of dominant. So it's time, and that's because it's just tempting, isn't it? It's so tempting to distill things. In Scotland, we know a lot about distilling. But when you distill things, you throw lots of stuff away. So what do you throw away? Psychology, philosophy, politics, all the stuff that is fairly clearly crucial in the world that we live in today. So the library mistakes is simply a business and financial history library. Now, there are lots of mistakes in it. That's the nature of the human condition, that we make lots of mistakes. But the rationale for having the library is to popularize and teach business and financial history. I mean, those spreadsheets, the discounted cash flow, those are the bones of life. But they're not the flesh. They're not the intestines. They're not the mind of life. That's not the way markets work. So we've been pushing back against that now for really some time. I mentioned the course. It's been running for 20 years. The library's been running for over 10 years. We've got one in Edinburgh, Lausanne, and Pune, and we should have 4 more open next year. Not in Manhattan, however, because I've been told by the people in Manhattan that Manhattan doesn't do mistakes. I'll let you be the judge of that. In my opinion, it's the world's biggest exporter, but anyway, we can't get the good people of Manhattan to admit to needing a library of mistakes. So look, it's a business and financial history library with a funny name, and the funny name is to get it publicity, because I've never ever believed in build it and they will come.
What is the status of education about money and finance and financial history in Europe? In the US, we don't really teach it. It's getting better. Maybe a quarter of high schools even teach one course on money, something. What's it like in y'all's part of the world?
Dreadful. I mean, I don't know what I don't want to put us below or above America. I could just tell you that it's absolutely dreadful. The library mistakes is charity. Charity also runs things in schools where we teach basic personal finance, which is not about the stock market investment. It's just about budgeting and compound interest rates and pretty basic stuff. And we as a charity have to teach that because the education system doesn't. So we have that at that end of the scale. And then at the other end of the scale, which is finance and universities, and it's still very much seen as a mathematical discipline. And we think there's much, much more to it than that. So right along the spectrum from early years to, I would go as far as postgraduate, we are not teaching the real world to our students. And you may know this story. During the Great Financial Crisis, the students of the University of Manchester, that's here in the United Kingdom, were sitting at home watching television with their parents, and they were saying, tell us what's going on, explain to us what's happening. You are students of economics. And they couldn't. So they went to their teachers and said, you explain to us. And they say, well, that's not on the syllabus and we're not going to teach you that. And you thought, well, you're so far away from the real world. So I'm not saying we should rip it all up and throw it away. But, right along the spectrum here, we've got a failing to embrace the real world because the models are so attractive. And the models are, there's a really good book by, I think it's Manuel Derman, called Models Behaving Badly. Don't Google it because you might get the wrong images up on your screen. But anyway, models behaving badly. And the models are really failing us over and over and over again. And yet we can't abandon them because they give us this false certainty, that lesson 21. A false certainty that we really just can't give up. So we're trying to do something about that. And, it's a small thing. It's in a small way, but at least we're trying to do something about that.
Tell me a little bit about, we got a lot of professional investors listening here. The Solid Ground newsletter. You've been doing this, man. How long, Russell? You've been doing this since the 90s, I think. Been putting pen to paper.
We're in year 31. I just put out my 31st pre-Christmas annual report. I'm looking to my right because I got some of the early ones framed up on the wall here. And so I started off in Asia, writing in Asia as a strategist for an Asian stockbroking firm called CLSA, but now I write about the whole world. I mean, there are 20 of those come out. And it is everything we've talked about. It's a mix of history. It is a focus on money and credit, which is still fairly rare, which always surprises me that lots of people there are other people who do it, but it's not in terms of strategy, it's not a big focus. So money, credit, financial history. When you put financial history in, you are blending in politics and sociology as well. And it's for the long-term investor. It's absolutely not a newsletter for people who are into the business of trading. It's about asset allocation to preserve the purchasing power of wealth over the long term. And fortunately, there's still enough people who are interested in that, rather than trading, to be reasonably good business. But most of my clients are actually institutional investors, but it is open to high net worth individuals. You have to, for regulatory purposes, you have to warrant that you fall into that class.
Russell, this has been awesome. I'm so thankful to finally get you on the pod. We got to do it again soon. What's the best place if people want to, find out more about your course, the library, the writing, the books? I mean, one day, by the way, it's not today because we haven't had one in forever, but I would encourage the listeners to go read your book on bear markets because we may have one here in the US again one day. Maybe not. Maybe it's just forever and up and to the right, but it's a really fun read. What's the best place? Is it russellnapier.co.uk?
That's for the strategy report, for sure. Librarymistakes.com, you will find about the library. I would say that we run lectures at the Library on Financial History. We record and live stream all of them. So if you go to librarymistakes.com, you'll find a lot. Trying to work out how many, 30, 40, 50 videos of very renowned speakers talking about financial history. And also some of the world's greatest investors come to the library and talk about what they know or don't know. We just had Tom Gaynor of Markel. That's the quality. Anthony Bolton, maybe not so well known in America, very famous over here. It's all free. It's a charity. It's all up there, librarymistakes.com. You'll find information on the course there as well, which is online as well as in person. And everything on that website is charitable. It's all there for free, and it's all charitable. And the course, if you choose to take it, the proceeds support all the charitable activities elsewhere. Newsletter, russellnapier.co.uk.
I'm going to ask you a tough question. This is really hard for me, but I think you'll easily answer this, which is, as you think about all the gazillions of books on your bookshelf behind you, are there any in particular that you think really speak to you and under the caveat of even maybe less well known? I mean, look, you can say security analysis if you want, but what reads would you particularly say, hey, look, this spoke to my heart, or I love this, or interesting, whatever it may be?
Yeah, well, I think the one that is essential reading is called Triumph of the Optimists, sadly out of print. And it's just a review of returns from financial markets. And it sounds like the most tedious book in the world, but maybe the most tedious book in the world is the most informative book in the world. You know, you and I are brought up in a world where we know that if you drop an orange, it falls to the ground. And we know if you hit the accelerator of a car, roughly how quickly it will accelerate. But most don't know what the long-term return from bonds is or the long-term return from equities is. They don't know the range of those returns in different environments in different countries. And that's all in that book. Now, unfortunately, it ends in 2020. It is kept up to date for professionals. And that's, if you are a professional, you can get that. But I would certainly say that you need to calibrate yourself. We all need to be calibrated. We're calibrated in real life every day. We walk down the street, we cross the road. We're calibrated. Quite often we end up in this business or manage our own money. We're not calibrated. So calibrate yourself. The one that makes me smile, and I think makes most people smile, is The Money Game by Adam Smith. So Adam Smith is not the 18th century Scottish economist and philosopher. By the way, I know 250 years ago, something rather important happened in the United States of America. But 250 years ago, Adam Smith published The Wealth of Nations. So something else kind of important happened in Scotland as well. Not as important, but almost as important. Yeah, The Money Game by Adam Smith he was a George Goodman, a journalist in the 1960s. But he writes about the market, and as soon as you pick it up and start reading it, you realize that this thing doesn't change. This is more short term. It's more about trading. But it inures you to some of the stupidity of markets because you realize there's nothing new in this stuff. We changed the name of the instrument, but the way the market thinks. And that was really about a great big tech boom in the mid-1960s. And it'll make you smile. There's not many books in finance that make you smile, but The Money Game by Adam Smith will do that. And anything by Jim Grant. I mean, doesn't really matter what it is. Jim's a beautiful writer, but he writes exciting stuff.
This is a great sign that you're a brother from another mother, a kindred spirit, because I had Triumph of the Optimist is my single favorite investing book. And I had a post from last summer where I said, here are five of my favorite investing books, but the criteria in financial history books, criteria was they had to have less than 50 reviews, meaning people generally, they weren't huge bestsellers. And crazily, Triumph of the Optimist is on that list. And I said, how is this possible? This book is so good. And there was a few others. Being Right and Making Money from Ned Davis was one. It's now got 51 reviews. So a new one to me, The Art of the Market. This was from the 90s, which looked at a lot of the old stock certificates over the years. Beautiful book. And another one, Paul Erdman, The Silver Bears, which, there's no silver bears anymore. It's all silver bulls. But
that one I don't know, so I'm going to track that one down. And as we were speaking, so other people will be doing it and the price will be rocketing.
Paul Erdman, these are fictional books, but it's from the 70s. And he wrote a handful of books that almost read kind of like, novels, but a couple pretty good ones. Silver Bears was my favorite. And another one was called 2020 Vision, which was 2007 from Harry Liam. Anyway, listeners, we'll put the link in the show notes so you guys can check them out.
Let me give you another novel then. The Gap in the Curtain by John Buchan. Famous over here. And he wrote the 39 Steps, but it's nice. Fortune teller tells everybody what's going to happen to them at a date in the future. And they then plan their lives around knowing what's going to happen to them at a certain date in the future. And of course, it's a disaster.
And this is by John
Buchan, B-U-C-H.
Buchan.
Because the problem is you know where you're going to end up, but you don't know how you're going to get there.
On occasion, I'll do these posts and I'll say, imagine if we went back a year. Imagine we went back 5 years. And I told you ahead of time that gold was going to be up 60% and silver up 90% in the next year. What conditions do you think would be going on in the world? And it's always fun to look back because people will be like, Fed funds rate at 9%, inflation, war, whatever. And I was like, actually, these other conditions are total. It's always fun to look at, hey, if I told you this.
There's a great lesson there because in my course, I have a chap called Herman Brody who teaches on that on behavioral finance. And he says, you got to keep a diary. And he's right. I mean, I obviously do that because I write for a living. You got to keep a diary and say, here are the 4 things I thought would happen and the price would do X. because sometimes the price, as you just pointed out, does X, but it's not for the four things. Well, if you can't remember, if you didn't take a note, what are you really learning? So keeping a little diary on why you're taking a position and then going back and reviewing it at the end of the year to see whether those things happened or not. It's part of the education of all investors. And yet, as Herman says, he's met some of the world's smartest investors, most successful investors, but they don't absolutely know why they're smart. But had they kept the detailed diary, they perhaps would have had a better idea of why they're smart. And it's a bit crushing that they didn't do that.
That's a great thought, listeners. Maybe we need someone to publish. Maybe we need Russell to publish a diary guidebook to be our psychologist and walk us through how to think about this crazy world we live in. Russell, it's been a blessing. Thanks so much for joining us today.
Sure, Meb. It's been fun. Thank you.
Podcast listeners, will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.